Most Canadians are using the wrong investment account, and it's costing them tens, sometimes hundreds of thousands of dollars over the course of their lifetime. RRSP versus a tax-free savings account. Everyone has an opinion, but there is a right answer, and it depends on one thing almost nobody explains properly. Today I'll show you exactly which one you should use first and why getting the wrong one can quietly ruin your financial plan. So welcome back, guys. My name is Jeff, and if you've ever wondered whether you should invest in a tax-free savings account or an RRSP, you're not alone. Most people also question this at some point in their life, and it can sometimes be one of the most confusing topics in Canadian personal finance. So today we'll cut through all the noise and we'll get rid of any hype. There'll be no blanket advice. It'll just be Canadian tax rules, real examples, and a clear framework you can actually use to decide which one you should be doing. So growing up, most Canadians are told something like, use your tax-free savings account when you're young. It's way better when you're younger, and only use the RRSP when you're older or making more money. Sounds simple, kind of accurate, but it is incomplete. The real difference between a tax-free savings account and a registered retirement savings plan isn't the account itself, it's when you pay the taxes on the account. Once you understand that, the decision can become a lot more obvious. So let me break this down and explain it in the simplest way possible. The cleanest way to think about something like this is a tax-free savings account, or TFSA. You pay tax now when you earn the income as personal income tax, and you never pay it again once it's invested. With an RRSP, or registered retirement savings plan, you get a tax break now on earned personal income, but you pay the tax later when you withdraw. So you're just deferring it instead of paying it now. So that's pretty much it. Everything else flows on from that. So going back to a tax-free savings account, it can sometimes be one of the most powerful Canadian tools for personal finance, and most people underuse it. Inside a tax-free savings account, your investment grows tax-free, dividends are also tax-free, capital gains also tax-free, withdrawals tax-free at any time, and it doesn't affect your government benefits later on. The last point matters a lot later on in life. If you invest inside your tax-free savings account for 20 to 30 years, every dollar of growth is yours. There's no Canada Revenue Agency bill ever. And now for the RRSP, they're often misunderstood by most people. When you contribute to an RRSP, or registered retirement savings plan, you reduce your taxable income by that amount, which will usually give you a tax refund on that year. The thing is though, that money is not tax-free, it's tax deferred. So every dollar you make will count as income when it's taken out, and you'll be taxed at your marginal tax rate at the time you withdraw it from your account. RRSPs work best when you're in a very high tax bracket today and you expect it to be lower when you retire. So the question that nobody asks, and the one that usually is the one that matters most, is will your tax rate be higher now or in the future when you're retired? If your tax rate is lower today than it will be in the future, tax-free savings account usually is the go-to and the best winner for that. If your marginal tax rate is higher today than you expect it to be in the future, let's say when you retire, the RRSP is going to win today. So that's really the entire framework between RRSP and tax-free savings account. It doesn't matter as much as your age. Like people talk about, oh, age matters the most and when to switch from one account to the other. That's not really how it works. It's more so your income today versus income in the future. And that's what matters to decide which account is best for you. So a quick example to kind of break this down is if you're early in your career, say making $45,000 to $60,000, your tax rate will be relatively low. Using your RRSP now will save you some taxes, but not very much. You'll likely be in a higher tax bracket later on in your career and your life, and that would make more sense. So in this case, a tax-free savings account first almost always makes more sense. You can lock in tax-free growth forever at a young age. Now for a second example, say you're mid-career, higher income, you're making $90,000 to $130,000. Lots of people think that's unrealistic money, but it's really not. You'll be paying a much higher marginal tax rate. So RRSPs could generate some pretty large tax refunds when you do your taxes. And if you expect your income and retirement from here to be lower once you do retire, your RRSP first makes way more sense. Now, the third example is where some people find themselves later on in their career, or depending on what you get into early on in your career. And if you're making $150,000 per year or more, which happens, RRSPs become extremely powerful. You can maximize your contributions every year, and you'll defer those taxes on every dollar you put in to when you're possibly retired and have a much lower marginal tax rate. Many high earners will start by maxing out their RRSPs to get the maximum tax refund later on, like that year. And then they'll use their tax-free savings account for tax-free flexibility for whatever money they may have left, because lots of people making 150 plus a year aren't spending at all. So now another point, the tax-free savings account really valuable over an RRSP is with things like government benefits. And that's where it stands out heads above the RRSP, is tax-free savings account withdrawals in the future don't count as income. They don't reduce your OAS or old age security, and they don't reduce your GIS, which is a guaranteed income supplement. Now with RRSPs later on, they do count as income. Every withdrawal, every dollar counts as income. So it can trigger something like an OAS clawback from the government. That means in your retirement, your tax-free savings account gives you far more control over your taxes and your benefits than an RRSP would. So the ideal strategy for most Canadians and a smart approach would be use your tax-free savings account first while your income is low to a moderate level. Then as your income rises, start introducing more RRSP usage and use both strategically. Never let choosing your account stop you from investing until you do more research and things like that. Invest while you can. If you have money and you want to invest, don't let either one of them stop you. The biggest mistake most people use isn't choosing the wrong account. It's not investing at all, because they're sitting there thinking, which account do I use, and overthinking it, making it a big situation it doesn't need to be. So common mistakes people need to learn to avoid that I see all the time is using tax-free savings account as a savings account and not an investment account. It's not somewhere just put money in and leave it. You should invest with that money. Another mistake people do is contributing to RRSPs solely for the refund and not planning their future with it. Spending RRSP refunds as soon as they come back from when you do your taxes, instead of investing it, is another big mistake lots of people make. A fourth mistake lots of people make is ignoring your future tax brackets and where you expect to be, and just thinking about only today and only this minute. And the other fifth and final thing that lots of people do is think one account is better. It's not always better. It's very, very valuable lots of times to have both the tax-free and the RRSP and use them equally. Just because personal finance is personal doesn't make the tax rules personal. Tax rules are just math. So a final takeaway and quick breakdown is a very simple answer for everybody. If your income is low today, use your tax-free savings account. If your income is high today, start with your RRSP first. If you expect your income to rise over time, like most people do as their careers progress, use both strategically from start to finish. If you get this right early, it'll give you a massive advantage for decades to come. If you guys want me to do a follow-up video for this, I can use exact dollar amounts for how much you guys are making, things like that, and show how much money you would have in your tax-free savings account versus your RRSP over 30 years at different income rates. Drop a comment below, say something like show the math. I'll do it anytime. And if you guys want more Canadian finance videos that are actually making sense, hit subscribe and I'll pump more out.